Hello and welcome back to Module 5 of the Technical Analysis Masterclass, Trading Inside a Range. When the market is trapped on a larger time frame, there are often good trading opportunities that present inside the confines of the range. Section 6 of this course focuses on trading in the middle of the range-bound market, and which chart patterns are most effective in this environment. In this lesson, you will learn the benefits of trading inside a range-bound market, how to trade double top chart patterns in the middle of a range, how to trade double bottom chart patterns in the middle of a range, and how to scalp potential double top and double bottom patterns inside a range. Let's first take a look at trading in the middle of a range-bound market. When the market is in a range-bound channel or triangle on a larger time frame, such as a 4-hour or daily chart, traders have more opportunities to capitalize when trading the zone. As I mentioned earlier in the previous section, trading the tops and bottoms of range-bound zones are a very good way to utilize chart patterns to help identify the next potential move. The chart patterns I mentioned earlier that were suited to the tops and bottoms of channels and triangles are no different on the bigger time frames and should be traded in the same manner, following the same rules. The great thing about range-bound markets on the larger time frames are that they often have trends forming on the smaller time frames as price travels throughout the range. As you can see in the example on the screen, although price is trapped between the support and the resistance zones on the larger time frame, price is very clearly trending between these zones on the smaller time frame. These trends give traders the opportunity to trade the reversal chart patterns inside the large consolidation with clear expectation of where the market is likely to gravitate to. There are two important rules that you must follow when attempting to trade a reversal chart pattern inside a large consolidation zone. Firstly, the consolidation zone must be large enough to allow the chart pattern to reach its projected take profit target before it reaches the large time frame support or resistance. And secondly, the trend on the smaller time frame must be making clear higher peaks and higher troughs in an uptrend, or lower peaks and lower troughs in a downtrend. If the chart pattern forms in the middle of a large time frame consolidation and the projected take profit target is under the key resistance or above the key support, the chart pattern has a far better chance of moving in the desired direction. This is because the price will naturally gravitate to the key support or resistance levels, which helps the momentum of the chart pattern. For the second rule, it is important for the smaller trend to be clear to ensure that the price doesn't get caught in a consolidation pattern in the middle of the channel. If the trend on the smaller time frame is clear, the price momentum has a far better chance of reaching the top or bottom of the channel or triangle. There are some key methods that we have found work best when trading inside range-bound markets, and I will now explain each of them and look at how to identify these potential opportunities. Please note that although the remainder of this section will use horizontal channels to demonstrate a range-bound market, triangle ranges work just as effectively, and the concepts are interchangeable. Let's first take a look at double top chart patterns inside a range. As I have mentioned in previous modules, the chances of a double top or double bottom pattern success can rely heavily on where it appears. Although they are generally considered a reversal pattern, when they are used to reverse a counter trend into a prevailing trend's direction, the chances of success increase significantly. This is especially evident when this pattern appears inside a channel or a triangle. We can see in the example on the screen that there is a downtrend in motion, with a series of lower highs and lower lows. Towards the end, we can see prices fail to make a lower trough, and has traced back to make a peak at around the same level as the previous lower peak. Now this gives us the first clue that the double top could be forming in the direction of the trend, but to keep in line with the rules of this pattern, we must wait for the double top to be validated before any further action can be taken. You can now clearly see where the neckline can be drawn, and once this level is broken, a trade can be placed in the direction of the existing trend. There are several ways that this pattern can be traded. The first one is a standard entry. The standard entry method is used when a trade is placed as soon as a candle or bar closes below the neckline in the time frame that the pattern appears the clearest. The general stop loss and take profit rules for double top patterns are used for this type of trade. The second way to enter this trade is with conservative entry. The conservative entry involves allowing price to move past the initial break of the neckline with the expectation that price will pull back to the neckline not long after. A trade can be placed short when price retraces back to the neckline and the candle or bar closes below it in the time frame that the pattern looks the clearest. The general take profit rules apply with this method, but unlike the traditional stop loss rules, the stop loss for this method is placed just above the previous peak above the neckline. If price breaks through the neckline and comes back to retest the level, you will generally see the appearance of a role reversal area, which helps strengthen the zone. This means that not only has the support level been broken at the neckline, but if price returns, it will be further bolstered by a role reversal zone, which will provide an added layer of resistance. Now let's take a look at double bottom patterns inside a range. As it was with double tops reversing a counter trend in the direction of the bottom of the channel or triangle, double bottom chart patterns are a great way to reverse a counter trend into the top of the channel or triangle. We can see in the example on the screen that there is an uptrend in motion, with a series of higher highs and higher lows. Towards the end, we can see prices fail to make a higher peak, and has traced back to make a trough at around the same level as the previous higher trough. This gives us our first clue that the double bottom could be forming in the direction of the trend, but to keep in line with the rules of this pattern, we must wait for the double bottom to be validated before any further action can be taken. You can now clearly see where the neckline can be drawn, and once this level is broken, a trade can be placed in the direction of the existing trend. What helps validate this double bottom is a new sequence of higher highs and higher lows that commence at the start of the double bottom, which break the neckline, helping reinforce momentum in the trend's existing direction. Once again, there are a number of ways that this pattern can be traded. Firstly, we have the standard entry. The standard entry method is used when the trade is placed as soon as the candle or bar closes above the neckline in the time frame that the pattern appears the clearest. The general stop loss and take profit rules for a double bottom pattern are used for this type of trade. With the conservative entry, it involves allowing the price to move past the initial break of the neckline with the expectation that price will pull back to the neckline not long after. A trade can then be placed long when price retraces back to the neckline and the candle or bar closes above it in the time frame that the pattern looks the clearest. The general take profit rules apply with this method, but unlike the traditional stop loss rules, the stop loss for this method is placed just below the last trough below the neckline. Now let's take a look at scalping trading potential double top and double bottom patterns inside a range. So far in this section, we have discussed using the standard and conservative entry method when trading double top and bottom chart patterns inside a trading range. Another way to trade double top and bottom patterns is by using the aggressive entry method, which involves predicting that the pattern will form and scalp trading the second peak or trough to the potential neckline set as a profit target. This trading strategy is the most aggressive way to trade inside a double top or double bottom pattern, as you are essentially trading what could be a double top or bottom without any validation. This means that you are trading with less information than the standard or conservative entries, but the success rate of this method is certainly solid. Let's take a look at a potential double top aggressive entry scalp. The example that we can see on the screen is a potential double top aggressive entry scalp. The sell position is placed at the second peak, with the take profit level set at the potential neckline of the pattern. It is important to note that this aggressive entry method should only be applied when you are trading a double top in a downtrending market. This method is too risky and has a poor success rate if you are attempting to trade a potential double top pattern with the aim of reversing a prevailing trend. Now we'll look at a potential double bottom aggressive entry scalp. The example that we can see on the screen is a potential double bottom aggressive entry scalp, where the buy position is placed at the second trough with the take profit level set at the potential neckline of the pattern. As it is with the aggressive entry method for potential double tops, the aggressive entry method for potential double bottoms should only be applied when you are trading the potential double bottom in the uptrending markets. This method is too risky and has a poor success rate if you are attempting to trade a potential double bottom pattern with the aim of reversing a prevailing downtrend, and can be likened to trying to catch a falling knife. Let's now take a look at candlestick pattern confirmations and see how they can assist us in making these aggressive trades. As I mentioned earlier in the module, some of the most popular candlestick patterns tend to be reversal patterns. I find that, like reversal chart patterns, reversal candlestick patterns are more potent when used in the direction of the prevailing trend. There are a few reasons why this is the case, and aside from the fact that trading in the direction of the trend is generally going to give you better results, candlestick patterns traded in isolation are not generally reliable, especially when they are used in an attempt to reverse an existing trend. However, when they are used to confirm a chart pattern, they develop a whole new level of reliability and accuracy. It is important to note that the candlestick patterns that we have discussed have been used to reverse counter-trend positions in the direction of the prevailing trend, and you are unlikely to see any of these reversal candlestick patterns appear around a standard entry. Let's see how candlestick pattern confirmations help a double top aggressive entry. In an aggressive entry scenario, you'll be looking for a candle pattern that helps signal the potential of a double top pattern at the second peak. The example that we can see on the screen shows what a confirmation candle would look like at a double top. See how on the second peak, there are 5 different formations that could help signal the start of a double top pattern forming. The aggressive entry is trading the general candle pattern rules at the top of the second peak, using the first touch of the neckline as your take profit target. It is very important to remember that trading this aggressive method is not trading a double top pattern, rather, trading a candle pattern inside what potentially could be a double top formation. With a potential double top formation appearing, the candlestick pattern has the added benefit of a defined profit target that isn't relying solely on the candlestick pattern alone, as there may be traders placing trades in the direction of the anticipated double top. Finally, let's look at the double bottom aggressive entry pattern and see how the candlestick confirmation can help in this scenario. You'll be looking for a candle pattern that helps signal the potential of a double bottom pattern at the second trough. The example on the screen shows what a confirmation candle pattern would look like on a double bottom. You can see how on the second trough, there are 5 different formations which could help signal the start of a double bottom pattern forming. The aggressive entry here is trading the general candle pattern rules at the bottom of the second trough, using the first touch of the neckline as your take profit target. Again, it is very important to remember that trading this aggressive method is not trading a double bottom, rather, trading a candle pattern inside what potentially could be a double bottom formation. With a potential double bottom formation appearing, the candlestick pattern has the added benefit of defined profit targets and isn't relying solely on the candlestick pattern alone, as there may be traders placing trades in the direction of the anticipated double bottom. In this lesson, we have learned the benefits of trading inside a range-bound market. We have learned how to trade a double top chart pattern in the middle of a range. We have learned how to trade a double bottom chart pattern in the middle of a range. And finally, we learned how to scalp potential double top and double bottom patterns inside a range. This concludes Module 5 of the Technical Analysis Masterclass. You can now continue on to the Stock Market Masterclass and the Trade Management module, which will teach you all about the correct risk and position sizing for the concepts that we have just covered in this course.